Good morning. I'm Paul Martin, President of Martin Healthcare Advisors, and we're back again talking to you about how to maximize the value in your rehabilitation business. In the last segment of our series, we discussed how to value a rehabilitation business. And what we talked about was that valuation really comes down to an earning stream multiplied against a risk factor, which inversely related, it becomes a multiple. So what we'd like to focus on today is how do we maximize the value in our rehabilitation business? Well, if the three risk factors that determine the multiple are size, the earning stream, or the confidence that a buyer has in the earning stream in the future, and referral risk, what we need to do is start looking at each one of those risk factors and develop strategies on how we can reduce and minimize that risk. And today what I want to focus on is the earning stream. Now, in some of our previous segments, we've talked about the value of developing operations, budgets, and targets, not only for you and the other owners and leaders of your organization, but also for each and every employee to review on a weekly basis. We talked about the, the metrics that matter the most and the metrics that we believe that you should be focusing on that will drive not only operational success, but we also discussed how it would drive financial success. In another segment, we talked about the value of financial statements and a financial budget, and how we believe that a financial statement and budget should be used on a monthly basis as a management tool, and that the structure of those statements needs to reflect an actual result compared to a budget and compared to the previous period as well as previous year to date for the previous year. And by having the ability to look at your revenue and your expenses in a very organized format in those three categories, actual to budget to previous year, we believe a financial statement cannot be used just to look at the end of the month to make sure you have money in the bank and make sure you've made some profit, but truly used as a management tool. So today, what we'd like to do is to discuss the value of the relationship between the operations report and the financial report. And we believe that that goes straight to minimizing that earnings risk. Because as a buyer looks at your business and they have an understanding that you know by driving certain operational results, it will result in a financial profit, or it will result in a financial to a financial gain. That is when a buyer begins to really understand that you have a good, strong handle on your business. And at any moment in time, you can tell very specifically the performance of that business operationally and how it relates financially. So how do we do that? Well, what we've done is we've developed a tool that takes the operations budget and it pulls right over to a financial report that we've developed. And by doing that, we can see again the financial, so we know if we achieve these financial results, it will result in revenue. And if we've also budgeted expenses, we can also look very quickly to determine what will the profit be from achieving these operational results. And that's something that I have found in very, very few businesses that business owners are able to do. And again, as I said, it crystallizes that performance on this side, on the operation side, result in a financial and the result of what kind of performance we will see on the financial side. I think it's important to just give you a quick example of a company we're currently working with and how this value has been transpired into results, not only operationally but financially. This is a company that had multiple clinics and it had a corporate office. And as we began to build the operations budgets and had them transfer over to the financial budgets, one thing that came very clear was that their corporate office had far too much staff because we were able to look at the percentage of corporate overhead to revenue. And so we went in and started looking, staff person by staff person, only to reveal that within this corporate staff there were certain positions that were very unneeded and unnecessary and were duplicative of things that were already being done. So we worked on that. The second step was to then look at each of the clinic's operational budgets. And remember, in an operational budget, we are very clearly focusing on productivity. And as we looked at the productivity of each clinic, and we took the staff list and the cost of the staff, we were able to make changes within the productivity levels which transferred right over to the financial budgets. So we could determine and see immediately what the impact of these productivity results would mean to the bottom line of each clinic. And I can tell you, in working through that through a 4 to 6 week period, that the results of that have been absolutely enormous, in that the business owners now see the direct correlation of operation results to financial results. And now we're going out and working through this with their leaders in their clinics as well as their clinical staff, so that everybody in the organization will be able to see that value. So again, going back on a quick review, if you remember how we value a rehabilitation business, we take the earnings stream multiplied by a multiplier, and that multiplier becomes larger with the least risk we have and smaller with the most risk that we have, with more risk that we have. So if we can reduce the risk, we increase the multiplier. If we can tie our operations budgets and results to our financial budgets and results, we will absolutely improve and increase that earnings stream, which will result in greater value. Thank you, and I look forward to coming back to you and talking to you again soon.